Here's something strange about SAP right now. The stock has dropped nearly 46% over the past year. That's the kind of number that usually means a company is in trouble. But when you look at the actual business results, something doesn't add up. Revenue is up, profits are strong, and the company just generated over $9 billion in a free cash flow. So why would a stock fall so hard while the underlying numbers look healthy? That's the question we're going to dig into. Let's start with the basics. SAP brought in $43 billion in revenue over the last 12 months. Out of that, the company kept $8.43 billion as pure profit. That gives it a profit margin of almost 20%, meaning for every dollar that comes in, SAP keeps about 20 cents after all expenses. That's a solid number for a company this size. And the gross margin, which shows how much money is left after covering the direct cost of producing its products and services, sits at nearly 74%. In plain terms, SAP is not a company struggling to make money from what it sells. That part of the story looks strong, but here's where it gets interesting. If the business itself is performing well, then something else must be driving that huge drop in share price. So let's look at how the market is pricing this company. Right now, SAP trades at a price-to-earnings ratio of 22.12. That ratio tells you how much investors are paying for each dollar of profit the company makes. A higher number usually means investors expect strong future growth, while a lower number can mean the market has become cautious. Compare that to the forward PE of 18.79, which is based on expected future earnings. That number is lower than the current one, suggesting that if earnings grow as expected, the stock could look cheaper going forward. That seems like a positive clue, but it still doesn't fully explain the sharp price decline. Let's follow the cash. Operating cash flow, which is the actual cash a company generates from running its core business, came in at $10.25 billion. After subtracting capital expenditures, the money spent on physical investments like equipment or infrastructure, SAP was left with $9.23 billion in free cash flow. Free cash flow matters because it's the real money a company can use to pay dividends, reduce debt, or reinvest in the business without needing to borrow. And SAP is clearly generating plenty of it, so this isn't a cash-starved company. That rules out one common reason stocks crash. Now let's check the balance sheet, because this is where a lot of hidden risk usually shows up. SAP holds $11.58 billion in cash, while carrying $9.06 billion in debt. Subtract one from the other, and the company actually sits in a net cash position of $2.52 billion. That means SAP technically has more cash than debt, which is a sign of financial stability rather than financial stress. On top of that, the debt-to-equity ratio is just 0.17, which tells us the company isn't relying heavily on borrowed money to operate. And the interest coverage ratio, which measures how easily a company can pay interest on its debt using its operating profit, is nearly 25. That's an extremely comfortable cushion. So debt isn't the villain here either. Here's the detail many investors overlook. Look at the moving averages. The 50-day average price is $169.82, while the 200-day average sits much higher at $213.51. When a shorter-term average sits well below a longer-term one, it usually reflects a sustained downward trend in price over recent months, even if the business fundamentals haven't collapsed. That single detail helps explain the disconnect we started with. The stock's price behavior has been telling a story of pessimism, while the financial statements have been telling a story of stability. Now the picture starts becoming clearer. Despite the price drop, analysts covering the stock have set an average price target of $254.33, which is over 56% above where the stock trades today. And the consensus rating from those analysts is labeled buy. That's a striking contrast to the mood created by the falling share price. There's also a quieter signal worth noting: return on equity, which shows how efficiently a company turns shareholder money into profit, stands at 16.35%. And return on invested capital, a measure of how well the company generates profit from all the money invested into it, sits even higher at 17.81%. Both of these suggest the business is using its resources effectively, regardless of what the stock chart shows. So let's bring the clues together. On one hand, SAP shows strong profit margins, healthy free cash flow, a net cash position, and low debt reliance. On the other hand, the stock has fallen sharply over the past year, and the moving averages confirm a real and sustained downward price trend. Analysts remain optimistic with a buy consensus, yet the market price tells a very different, more cautious story right now.